Assalamu alaikum everyone, hope you are doing well. So in this class I am going to explain you the possible solution to these important guest paper questions, and these are for AS Economics paper 2 that is going to be tested tomorrow, June 2025 attempt. So the first ever question here is question 1a. Explain the meaning of equilibrium price of a good and consider why it may rise due to the rise in consumers' income. Right, so examiner may mention any factor that may affect demand and supply, but in this question I have mentioned consumers' income, right? So examiner is not bound to use the income here. He may ask any of the factor that affects demand for goods and services. So for this question, what should be the possible answer? Definitely we know that we have to cater assessment objective 1, assessment objective 2 and assessment objective 3. Assessment objective 1 is knowledge, and this is for 3 marks in 8 mark question, and then we have analysis, this also carries 3 marks, and then we have evaluation, it carries 2 marks. So for assessment objective 1, you have to pick the main term that is given in the question. So equilibrium price is the main economic content that is asked in this question. So you will have to define what equilibrium price is. Equilibrium price is the price that is set at the intersection point of demand and supply curves. And you can make the diagram for equilibrium as well. So the diagram looks like this. This is demand curve. On X we have quantity, and this is origin point. On Y we have price, right? So this is supply curve. Demand and supply meet each other at point E, where equilibrium quantity is set at Q and price is set at P. So equilibrium price is the price that is set at the intersection point of demand and supply, and it has no tendency to change. So this will be the answer for question number for assessment objective 1 of 8 mark question. Now you have to analyze the situation. If there is rise in consumers' income, why the price of the product may rise. So keep in mind, whenever there is rise in income basically represents the purchasing power of the consumer. When there is rise in income means consumers' purchasing power will rise, and when purchasing power is high, consumer will purchase more goods and services. And demand for goods and services will rise, and demand curve will shift to the right. So this is the initial demand. On X we have quantity, this is origin point. On Y we have price. So this is supply curve. Intersection of demand and supply takes place at E. Equilibrium quantity is set at Q and price is set at P. Due to increase in consumers' income, demand for goods and services will increase. So as a result, demand will rise and shift to the right to D1. Equilibrium will move to E1, where quantity will rise to Q1 and price will increase to P1. So you have to make this diagram and explain whatever I was saying while making the diagram. There is explanation, and you have to copy exactly the same thing. Okay, so at the end you will have to give conclusion as well. For conclusion, you can say that rise in income does not always increase equilibrium price of the product. Rather, equilibrium price may decrease as well, because in case of normal goods, increase in consumers' income increases demand for the product. So demand will shift to the right and price will increase from P to P1. But on the other hand, if we talk about inferior goods that are low quality products, then increase in income decreases demand for the goods. So demand will move back from D1 to D, and price will decrease from P1 to P, right? So you can conclude that in case of inferior goods, the situation will be totally opposite. Moving to part B of this question, assess the usefulness of knowledge of price elasticity of demand and income elasticity of demand to a business. Examiner may mention any business name, for example transport company, for example computer seller, car sellers, or any examiner can mention any kind of product or service as well. So how to answer this question? Again, assessment objective 1 is the first thing you have to cater, that is knowledge. For knowledge, you have to pick the basic terms of economics here, that is price elasticity of demand and income elasticity of demand, and you have to explain what price elasticity of demand is and what income elasticity of demand is. So price elasticity of demand measures the degree of responsiveness of quantity demand due to the change in price of the product. And you can write down the formula as well, and percentage change in quantity demand divided by percentage change in price is the formula for PED. And income elasticity of demand measures the responsiveness of quantity demand to a change in income. Right, so this is the basic knowledge here, and then you can move to the analysis part. For analysis, that is assessment objective 2, you will explain how price elasticity of demand helps the businessman to increase their revenue. Definitely every business wants to maximize revenue and profit, so price elasticity of demand guides them whether to increase the price or decrease the price. So it depends on whether the demand is elastic or inelastic. In case of elastic demand, seller decreases the price. When price decreases, quantity demand will increase a lot because demand is elastic. So as a result, total revenue of the business will increase. And you can, if you wish, you can make the diagram as well, and the diagram can be flatter demand curve. Otherwise you can just explain with explanation as well, right, instead of making graph. And on the other hand, if the demand for the product is inelastic, then it means seller can increase the price. When he increases the price a lot, quantity demand will decrease a little bit, so as a result total revenue will again increase. So price elasticity of demand has helped the businessman to charge high prices when the demand is inelastic. And now talking about income elasticity of demand. Income elasticity of demand is useful when we compare the types of goods like normal goods, inferior goods, luxury products, basic necessities of life. So if there is economic recession in the country, whenever there is economic recession in the country, economic recession is basically economic downfall in the country. Means at this time consumers' income will be low. When consumers' income is low, people purchase more quantity of inferior goods. So when income decreases, quantity demand will increase for the inferior goods. Inferior goods are the low quality products. Since there is economic recession or downfall, so people have less income, and when they have less income, they purchase more of inferior goods. So it guides the businessman to produce more of inferior goods at this time if he or she wants to avoid losses or earn profit. But in case of economic boom is the economic uprise in the country. When there is uprise in the economy, then it means people have more income, and when their income increases, they demand more. Quantity demand will increase for luxury products or normal goods, right? So luxurious products are the products that make life comfortable, so everyone will wish to purchase more of luxurious products whenever there is economic boom. So it again guides the businessman through income elasticity of demand that he should produce more of luxury products instead of inferior goods during the period of economic boom. And when he does that, he will be able to earn more and more profit. So this is the analysis part, and now you have to move to the evaluation part. During evaluation, you can say that price elasticity of demand and income elasticity of demand are calculated based on the past data that might not be valid for the current situations, right? Similarly, price elasticity of demand and income elasticity of demand only consider the change of price and change in income, while there are so many other factors in real life that affect demand instead of price and income only, right? So again, it makes income and price elasticity of demand less relevant here in this case. And similarly, price elasticity and income elasticity of demand are based on previous predictions and previous expectations, and that are replicated to the future situations, and they might not be valid for the future, and there may be economic crisis, or there may be economic changes, there may be wars may be occurring between countries, and natural disasters may also occur where the situation will be totally different. Instead of considering the price of the product, consumers would be considering other factors like uncertainties in the market and so on and so forth. So you can explain why it might not be useful for the businessman. And at the end, you can finally conclude that In conclusion, price and income elasticity of demand are really important concepts of microeconomics that help the producer to charge the prices accordingly or change the production decisions for normal and inferior goods as per the economic conditions of the country. Right, so you can conclude your answer this way. And in the next video, I'll be explaining the next question. See you soon, inshallah. Allah Hafiz.